Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Vivek Iyer, and it's a quiet, nothing sort of a Tuesday morning. Markets are trading absolutely sideways, lacking cues and triggers, and it's flat now on the benchmark indices. The mid-cap index, though, and the small-cap index is faring a bit better. Though the mid-cap index has come off from the session highs, it's still holding up with a gain of close to about 0.3%. Small-cap index too positive, advanced decline ratio skewed in favor of the stocks advancing. Sectorally, it's FMCG, which is up and about, led by names like an ITC, Tata Consumer, Nestle, HUL. In fact, if you look at the top gainers list on the Nifty, 4 out of the 5 belong to the FMCG pack. And then you've got Pharma too. The Nifty Pharma Index is inching up. So that's another pocket of strength. But on the way down, you've got the Bajaj twins reversing some of yesterday's euphoria. BPCL is also under pressure. And you've got some softness in banks like an Axis Bank. Hi.
Good morning. Like you mentioned, a little bit of moderation as far as the benchmark indices are concerned. Almost 13 straight gains, 13 straight sessions of gains, and after that, a little bit of moderation, something largely along anticipated lines. Focusing on a couple of stocks today. First on the list, have a look at Premier Energies. The stock or the company listed just around an hour back. Stock more than double, at the open itself. Now, we just had the management on Chartbusters around 15-20 minutes ago. Well, the management guidance as far as FY25 is something that the street will look at very closely. On a base of FY24, the management says that they would be able to go ahead and double the revenue. And this is something that the street has taken note of. And the stock, almost 94% higher from the listing price. Now, the next couple of stocks on the radar, if you're talking about, the Garden Reach shipbuilders, you're talking about the shipbuilders names like Cochin Shipyard, Mazagon Dock, all of these names doing very well in the session. This is ahead of, the cabinet meeting where the Defence Acquisition Council will actually have a look at, what are the next set of orders to be given to these shipbuilders. On the back of that, there is significant up move in these names, all of them up in the range of 4 to 7%. However, moving on, what we're actually looking at is HAL, that's another defense company on the radar. Upasana is here with us on the back of the fact that Antique is quite bullish on the stock, and there's been some news flow as well. Upasana, over to you.
Thanks so much for that. HAL remains in focus as Cabinet Committee on Security has approved procurement of 240 aero engines from HAL. This contract is valued over 26,000 crores and deliveries will commence 1 year from now and is expected to be completed over next 8 years. On back of this development, Antique has given a buy rating on the stock with a target price of 6,145 per share. It says that this order will further bolster company's already strong order backlog of 94,000 crores as of FY24 to 1.2 lakh crores. It says although the near-term financials may seem a bit volatile for the company, as company has been facing challenges to execute large Tejas Mk1A orders, but despite of all this, it believes that the stock is attractively valued with a multi-year double-digit earnings growth potential. At the current juncture, the stock looks attractively valued with robust return profile of 20% plus is what the brokerage has highlighted. So all in all, a positive note coming in from Antique on back of this development, and HAL continues to remain in focus.
Thank you very much for that. Let's talk about Aadhar Housing Finance and GMR Power. Both these two stocks are up nearly 5%. They're brokerage bets. Sudarshan joins in with the details. Sudarshan.
So two initiation today on Aadhar Housing Finance and GMR Power, and both these stocks are sharply higher in today's state. So first, Kotak Institutional Equities has initiated coverage on Aadhar Housing Finance with a buy call and target is rupees 550 per share. It says it's a large affordable housing finance company with a long track record, and its multi-pronged expansion and appraisal strategy will drive 21% AUM CAGR over FY24-27 with low credit cost, and stable margins and improving leverage will accelerate ROEs back to high teens. Next is B&K Securities has written on GMR Power. It has initiated coverage with a buy call and target is rupees 184 per share, and it implies almost upside of 38% from current levels. It says it has installed power capacity that exceeds 3 gigawatt. Also, it has 2 gas-based power plants which is currently stranded due to gas supply issues. And in transportation EPC, it has 3 operational highway projects totaling 730 lane kilometers. And going forward, triggers as per BNK is first, energy assets consolidated by acquiring stakes in GMR Energy. Second, thermal assets including Varora and Kamalganga. And also it has successfully restructured balance sheet, which has reduced debt burden and enhanced liquidity. And last is it has presence in smart metering with major contract in Uttar Pradesh that is valued at almost 7,600 crores. So positive report coming for GMR Power and Aadhar Housing Finance.
Okay, thank you very much for that. We're also looking at Matrimony today, and that's a stock which is up nearly 8-9%. This is ahead of the board meeting on the 5th of September, where the board will consider a buyback. The last buyback done by the company was a little more than 2 years ago in July of 2022. And right now, the cash in the company's books stands at 382 crore rupees. Now, the stock is up 9%, but it's done very well over the last 3 weeks. So if you pull up a 1-month chart, you would see the rally started somewhere in the middle of August when the stock moved up from levels of close to about 600 rupees and now to about 820. There you have that up move in the stock. And this stock surge happened despite the Q1 numbers being fairly average. The revenue number for the street will come for the company will come up. Revenues for the company were, absolutely flat on a quarter-on-quarter basis, marginally down on a year-on-year basis, though the EBITDA margin didn't inch up. It's a small company, market capitalization of close to about 1,800 crore rupees. Now, what will you watch going forward? Now, of course, the buyback details, which we will know on the 5th of September, but the companies also said that the Q2 revenues will dip compared to Q1 because of seasonality, and also Q1 saw lower billing. They also spoke about billing growth coming back from Q3 onwards, and they've also sought a shareholder approval to enter new businesses beyond the matrimony fold, and the company is exploring certain new initiatives. So if you ever get a chance to chat with the company, we would want to know about these new initiatives. But it's a surprisingly big surge in the stock price in the last 3 weeks, despite the Q1 numbers being fairly average.
That's right. So now I think we'll have to wait for the quantum and, what will be the actual acceptance ratio once the buyback does come into effect. Remember, in the last 3 months, we've seen a lot of buybacks come by, given the fact that there could be taxation implications, coming ahead as far as buybacks are concerned. But let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Welcome back to Trading Hour. Let's now shift focus to the commodity space. Manisha Gupta joins in, and today we are focusing on crude oil. Over to you, Manisha.
Vivek, thank you so much for that. Well, yes, the last 2 months have seen constant declines come in for the crude oil prices, and the month of September hasn't started on a better note itself. So we're looking at extension of declines, and this comes in on the back of strength in dollar index, which is trading at a 2-week highs, and then the China's economic data, whether it has been manufacturing numbers or factory activity for the month of August, have seemed to decline yet again, and that's weighing onto the markets. Apart from that, the street is watching out for the OPEC and allies, which put out a plan last month suggesting that they will start to phase out the voluntary output cuts of 2.2 million barrels per day in the next 1 year, starting from the month of October until September 2025. But with the way the demand has been slightly weak and the price is under pressure, the jury is out on whether or not OPEC will actually do that, and if there is a new statement coming in from this. But there is one positive one here as well. And this is the kind of crude oil imports that we've seen within Asia. That number seems to have improved. The month of July was quite weak. It was a 2-year low in sense of imports that we saw for the month of July. But August has seen a rebound. China imports at lower levels has been on the higher side, up by nearly 1 million barrels per day. And apart from China as well, within Asia, you also have India, South Korea and Japan imports quite on the higher side. So on the lower prices, the demand seems to be on the better side, and that's exactly what the street seems to be reacting to.
Thank you very much for that. We will slip into a very short break. We'll come back and discuss market technicals. We'll invite Sudeep Shah of SBI Securities on the other side. Welcome back. Housing finance companies are also in focus ahead of the mega IPO of Bajaj Housing Finance. The company's just released the pricing earlier in the morning, 66 to 70 rupees, which means, Bajaj Housing Finance is going to command a market capitalization of nearly 59,000 crore rupees. But ahead of that, a lot of the other housing finance companies are seeing buying. So PNB Housing Finance came up. Aadhar, there is that Kotak initiation, but you are seeing green on the screen even for others like LIC Housing Finance, Canfin Homes. Bajaj Housing Finance is coming at a premium to some of its peers. So can the others re-rate? I think the spotlight will come back on the entire sector. But let's talk about Kaynes Technology that's surging after the cabinet has approved the proposal of Kaynes Semicon to set up a semiconductor unit in Gujarat. Upasna joins in with the details. Upasna.
Thanks so much for that. Well, the stock will remain in focus as Union Cabinet has approved proposal of Kaynes Semicon Private Limited to set up a semiconductor unit in Sanand, Gujarat. The proposed unit will be set up with an investment of 3,300 crores and capacity of this unit will be around 60 lakh chips per day. On back of this development, management joined us earlier this morning and here are some of the important key takeaways. The company is expecting production from the Gujarat unit to start in Q3 FY26. It has also highlighted that the new unit will be margin accretive to existing business EBITDA of about 15%. The investment by Kaynes is expected to be around 800 crores. And it has also highlighted that in Q4 FY26, the company could see a 200 crore revenue from the chip unit. It has also emphasized that by FY29, the unit will reach its peak revenue potential of 4,000 crores at 85% utilization level.
Welcome back. There is a CNBC-TV18 exclusive which is flashing for you on your screen, where we pick up from sources is that the GST Council is likely to issue a clarity for car seats, there's four-wheeler seats and two-wheeler seats. So currently, car seats are being taxed, have a GST rate of 18%, while the two-wheeler seats have a GST rate of 28%. And I guess that disparity loophole is now going to be closed because the GST Council Fitment Committee is going to recommend rate parity between the car seats, four-wheeler seats and the two-wheeler seats. So the GST rate on the car seats will go up from the current 18% to 28%, bringing it on par with the two-wheeler car seats. So negative news coming in for some of the four-wheeler car makers, and things are going to get more expensive for the purchase of cars. But we'll try and get some more details on this particular stories. But getting back to that Kaynes story about the semiconductor development, we also chatted with the management earlier today. Let's listen into some of the comments.
We have done all our planning stage. We have acquired the land. So we should be able to quickly start the construction activity. Construction will take a year's time. And on the third quarter of 26, we are expecting production to start.
We would probably have about 4,000 plus crores of revenues coming in. In terms of margins, we have, I think from beginning itself, focused our capex on more on the advanced packaging area. So that's what is the more remunerative area. So about 25% of the capex is aimed at the legacy packaging, which is typically available in South Asia and all that. Whereas the 75% of capex is aimed towards advanced packaging, which is more the province of Taiwanese and Japanese and Americans. The commercial production starts off in third quarter. Fourth quarter, we'll have significant revenues, maybe 200 crores plus kind of revenues. We don't operate at 100% technically, right? So generally about 80% plus. So 80% plus can deliver up to about 4,000 crores. It entirely depends on what kind of work we do. So, but typically the asset turns in this business of about 1 to 1.5. So we're hoping to kind of set up our businesses and our portfolio of customers in such a way that we get a slightly better run rate on the asset turns.
Well, Kaynes Technology up almost 4% in the session today. Moving on, Brigade Enterprises is in focus after the company launched its QIP. Vamakshi is here with more details.
Brigade Enterprises is surging in how in the trading session today. They launched their QIP on September 2nd, that is yesterday, and they've approved a floor price of 1,164.7 per share, which implies a roughly 6% discount to the closing price yesterday. Now, sources suggest that the company is looking to raise 1,500 crores, which would roughly comprise of around 5.64% of the current equity at an indicative price of 1,150 per share, which implies a nearly 7% discount to the closing closing price yesterday and a 1.3% discount to the SEBI floor price. Now, sources suggest that these funds that the company is looking to raise will be utilized in repayment or prepayment of certain outstanding borrowings. Apart from that, the company is also looking to partly fund the cost of some of its land acquisitions as well as some other costs that would be involved towards JDAs and JVAs. The lockup period is 60 days on the company and 90 for the promoters and the BRLMs include IFL Securities and Kotak Mahindra Capital Company. But overall, given this development, the stock is surging in trade today.
Thank you very much for that. Let's talk about Vidanta. That's in focus after the company's board approved a third interim dividend. Nigel joins in with the details and the implications of this. Nigel.
Well, that's right. Vidanta has gone ahead and declared a dividend of close to around 20 rupees on a per share basis. This is the third interim dividend. Prior to this, they'd already declared close to around 15 rupees per share. Now, the total outgo because of this 20 rupee dividend payout will be roughly around 7,800 crore rupees. Of which, since the promoter entity has 56% stake in the company, they'll get 4,400 crores. Now, this is very, very good news because year to date, the total dividend payout is around 35 rupees per share. And why is it good? Because it puts the promoter entity at a far better financial situation. Remember, the concern for the company hasn't been what's going on at Vidanta Limited. The problem is that Vidanta Resources, which is the parent of Vidanta Limited, they have been sitting on a pile of debt, which currently is at around $5.5 billion. So late last evening as well, they have put out a release, Vidanta Resources that is, that they're looking to buy back some part of their bonds, which amounts to around $1.5 billion. And the lending rate, the cost at which they were borrowing this particular money was at around 13.75%. So why is this positive? Now they're going to be getting dividend. They could practically bargain for a rating upgrade, point number one. And the second part is they could refinance this much lower in comparison to this 13.75%. The street is working with a number of around 10 to around 11%. So good for the shareholders, they'll get this 20 rupee dividend, and better news for Vidanta Resources because now in terms of their leverage, they're in far better position right now. And the street likes that. And if that happens, if they get a rating upgrade, practically they could also bargain for a rating upgrade, which is the next trigger from here on. Back to you.
Thanks so much for that, Nigel. A very important trigger as far as Vidanta is concerned. Moving on, Sudeep Shah joins us for a quick technical check on the market. Good morning, Sudeep. Thank you so much for joining us. How are you looking at the markets currently? What are your Nifty targets? And can this momentum sustain that we've seen over the last 13 trading sessions?
Good morning, Vivek. Vivek, absolutely. It's a record that 13 trading sessions straight without closing in the red. And indices now post making this fresh highs closer to 25,300 and above yesterday. That's quite okay if they're consolidating for a day or two, and we are seeing a range-bound trade here, and stock-specific momentum is being visible. But overall, we feel the setup is quite constructive, and that's why we are bullish on the markets. And we feel that till 25,100 holds on the downside now. This rally can extend up to 25,430, 25,500 on the upside. And it's a matter of time now for Bank Nifty also. Like a strong base formation has happened closer to 50,900, 51,100 between that zone where the 20-day exponential moving average is there. And hence we feel that post this consolidation, there could still be some underperformance or sideways momentum. But overall, we feel that Bank Nifty is now poised for a rally up to 51,850, 52,200 on the upside.
Sudeep, hi, morning. So what about individual stocks? Anything that catches your fancy today?
A couple of them. One is from the mid-cap side, which is Castrol. Now, since we are seeing a stock-specific movement into the markets, Castrol had been on an uptrend in the last couple of months. But specifically coming to drilling down to the last, say, 15 to 17 sessions, it was in a range. So post a big up move, it consolidated, and today we are seeing some decent upside and good traction. So I feel from the current levels, Castrol can be bought with a stop loss of 263 on the downside and a target of 290 on the upside. The second stock that is there on my radar is Hero MotoCorp. Now, here we have seen that there was a consolidation in this stock since 21st of June between 5,200 and 5,400. And today we have seen a consolidation breakout on the upside. Last 4 sessions, the stock has formed a higher top, higher bottom pattern also. So we feel that within the auto space, specifically within the two-wheeler space now, Hero Moto could catch up to that rally that Bajaj Auto has already shown us. And on the upside, Hero MotoCorp is due for 58.30, 58.50 levels. And this can be bought with a stop loss at 55.80 on the downside.
Thank you so much, Sudeep. So Castrol as well as Hero MotoCorp are top picks for the day. Let's now take a short break. Up next, we'll discuss market fundamentals with Varun Lochap of HDFC Securities. Welcome back to Trading Hour. Varun Lochap from HDFC Securities joins us now to discuss market fundamentals as well as his top sectoral picks. Welcome, Varun, to the show. Thank you so much for joining us. Post Q1, you've made quite a few important changes as far as your own model portfolio is concerned. Can you take us through, which are the top ones, especially in the consumer space, and what is the rationale behind making these changes? We see that you've added Jubilant Food, but on the other hand, you've actually taken out a Britannia. So, what is the rationale for these changes?
Yeah, hi, good morning. So see, overall, we have been making a few changes to our model portfolio every quarter as, risk reward on various sectors and stocks keeps moving. And in a market which has been trending up, it has been moving quite sharply and in a short span of time. So generally in last 6 months, what we have been doing on our model portfolio is as follows. One, we have been cutting down on industrials and real estate where we were significantly overweight for 12 to 18 months prior to that. And we have been adding all three sectors, which is IT, banking, and consumer staples. Three sectors where we were underweight over last, again 12 to 18 months prior to previous 6 months. So if you'll see even the Q4 changes in terms of our model portfolio, we had added some more consumer staples. Now, for the first time in 4 years, we have gone overweight on consumer staples. Consumer durables, we had turned overweight 6 months back itself. Banking, we are still neutral, but we have been increasing our weight and going from underweight to neutral. And IT also, we are close to neutral right now. So this is broadly the sort of changes we have been making. In terms of specific stocks, as you asked, Britannia versus Jubilant, it's more a question of individual companies' risk reward. We believe Jubilant probably provides a greater medium-term upside, given the fact that SSG is now bottomed out in our view and should improve from here on. Our analyst has also turned constructive on that name. So that's the rationale. Britannia we still continue to like. So we have an add rating on Britannia, but a buy rating on Jubilant. So given the greater upside in Jubilant, we have added that one.
Let's talk a little bit, Varun, about Mphasis. Mphasis has been an outperformer in the last 3 months. I think in the last 3 months, Mphasis has gone up nearly 30%. Now, the key narrative playing out here is that the rate cutting cycle in the US will result in a recovery in their mortgage segment. So the same segment which led to the underperformance over the last 2 years will start, outperforming. And anyway, spending by large banks in the US is showing signs of a recovery. We saw that in Q1 as well. So why are you trimming your position in Mphasis? I understand the recent, outperformance in the stock, but is that it, or are there any other concerns when it comes to Mphasis?
So not overly concerned on Mphasis per se. If you'll see the changes, we had 2 stocks, Tech Mahindra and Mphasis, where we were overweight in the last 6 months in IT. And we have now actually trimmed our positions in both of them and actually added TCS, which is our top large cap pick. So in that sense, what we are also seeing is while recovery, as you rightly pointed out, is looking to be the base case scenario, especially in case of Mphasis verticals, our analyst does not see much upside from current levels, whereas on TCS, he still has an upside and a positive rating. Plus, large cap IT to us looks better placed compared to mid cap IT at this juncture, given the valuations versus the growth sort of outlook. So it's again very bottom up, but IT overall, you would see that we have maintained our weight in this current quarter. We have exited some mid caps and added some large caps in IT.
Just getting back to the markets per se, before we delve into other sectors and stocks, your projected earnings growth for FY25 is just 5.7%. I thought market expectation is that at least we will have, low to mid double-digit kind of growth this year. So just 5.7%. And is this not a cause, if we are going to see some earnings downgrades, is that not a big cause of worry?
Yeah, so see, you can look at it both ways. If you look at this 5.7% is for our coverage universe of around 230 stocks, which has both large cap, mid cap. Now, what is pulling it down in, is actually OMCs, which had a stellar earnings last year. So if you X out OMCs, the number for even FY25 is close to that low double digit, 10 to 12% kind of a CAGR. And on a 2-year basis, what we are projecting for our coverage universe is around 11% CAGR. So net, I think the way to think is still more, I think India Inc. corporate earnings will continue to grow at around 10 to 12% CAGR for next couple of years. But it's a significant sort of a moderation from a high teens kind of a growth which we saw in the previous 4 years. So, and therefore the return expectations have to be moderated given the fact that, valuations are looking stretched. And let me, while headline Nifty P may not look overly stretched, we just did one analysis, which I thought was fairly interesting. If you look at in FY19, Nifty P was around 21, 22 times, and today it is around 25 times on trailing basis. But in a 5 years time, banking sector has got derated by almost 50. And therefore, now the banking sector P is at 17 times. And if you look at ex-banking, that has got re-rated by 50%, and now the P stands at 30 times. So therefore, while headline Nifty P may not have changed a lot, there has been a lot of changes within that, and therefore, one has to be cognizant of, of the fact that right now almost 70% of stocks in Nifty are trading above, significantly above their long-term average valuations, which means that at some point, returns will get moderated, just the way it happened in banking. If we go back 5 years back, when rest of the market was available at a significant discount to banking sector, which was trading at 35p in FY19. So it has completely reversed in these 5 years, and from here on, again, we are seeing that the market is positioned on one extreme, where the entire industrials and the infrastructure theme and all is priced to perfection, while we are still believers in macro story and fundamentals being good. We believe the stock returns will be moderate from here on in some of those segments.
Right. So you've gone underweight as far as industrials are concerned, but moving to what is essentially a very large weightage as far as the Nifty is concerned, and even in the broader markets. Let's talk about the BFSI space. You said that returns here have been quite moderate over the last 5 years. From this point on, how do you see the banking pack especially move, and which will be your top picks over there, and where do you stay underweight?
Yeah. So in case of banks, still our preference is for large banks over small banks, and still largely for banks over NBFCs, but we have got actually both in our model portfolio. So in terms of the key picks, it is ICICI, SBI among the large banks, and Federal Bank among the mid-cap banks. So these are the 3 large picks. And in NBFCs, we like Chola, we like Aavas. So yeah, these are some of the names which are there in our model portfolio. As far as banking sector goes, as I said, now valuation part is corrected, and now it's at a 30% discount to Nifty versus 50% premium to Nifty, which it used to enjoy 5 years back. But at the same time, I think near-term earnings will remain muted in case of banking for next 6 to 12 months. So which means that maybe you may not see outperformance from this segment straight away, but from a medium term, we believe the risk reward is looking very healthy in case of actually both private and public sector banks. The large public sector banks are also looking fine to us, and the large private sector banks are also looking
okay. Thank you, Varun, for joining in. That's the view on the markets from HDFC Securities. Let's now go across to Sudarshan, who's standing by with an exclusive news update on a fundraise plan with respect to Samaran Madan. Sudarshan.
That's correct. So what we understand from our sources that Samaran Madan is looking to raise up to $1 billion via QIP, which is expected to be launched very soon. And for the same, bankers are already appointed and company is likely to begin the roadshow very soon. And as far as proceeds are concerned, company may consider acquisitions or debt reduction that fund that company is looking to raise via QIP. In the recent interview or after the earnings that company had released for Q1, company had said that it's looking to reduce debt to 1 times EBITDA from 1.5x that stands as of now. As far as debt is concerned, as of June 2024, gross debt was rupees 20,114 crore and net debt was rupees 13,370 crore, which had increased in the range of 16 to 20%. Also, along with earnings, company had said it's looking at the acquisition as well. As far as the story is concerned, CNBC-TV18 has written to the company and comments are still awaited.
Thank you so much for that, Sudarshan. A very important news break coming in there as far as Samaran Madan is concerned. A fundraise via QIP could be both for acquisition as well as debt, and we are yet to hear back from the company regarding this particular development. But time now for a short break. We'll be joined by Abishek of Sharekhan to discuss the auto sales numbers for the month of August. Stay tuned.
Welcome back. Let's talk about the auto space. Now, yesterday we got the August sales numbers where the key trend was two-wheeler makers outperformed. In the passenger vehicle, in the four-wheeler category, passenger vehicles did well while CVs were under a bit of pressure. But now all eyes will be on the festive season to see if there is going to be any pickup in the retail sales. We have with us Abishek from Sharekhan now to talk more about this entire space. Abishek, afternoon. Thank you for joining in. Now, two-wheelers continue with their outperformance, not just in the month of August, but even if you look at the numbers on a year-to-date basis. But stocks like Bajaj Auto have already done very well. In fact, Bajaj Auto is the top performer this year, calendar year 2024, with a 63% up move. So is there upside left in names like, say, a Bajaj Auto? And where do you stand on the other two-wheeler makers like a Hero Moto or a TVS?
So you rightly said that the Bajaj Auto has broadly outperformed the Nifty and the auto index both, and there was a certain reason that it has given such kind of outperformance, given that it has been largely considered as an export player. But in this particular year, when export has still to move up, the company has been largely positioning in the domestic market, and with its product mix and strong positioning in the premium category, the company has been continuously sustaining its 20% kind of EBITDA margin, and that has been reflecting in the kind of valuation which the company is gaining. Beyond that, its CNG product has also been getting healthy response in the market, and that has been fueling additional trigger for the company. And beyond that, what has been considered as a drawback for the company, that it has not been in the electric vehicle segment, but in this particular year, now if you check, take this advanced data, then it is market share in the electric two-wheeler space also been reached to around 18-19%. So all cylinders are firing well for the company, and that has been reflecting in the stock price and the valuations. Overall, we have been positive on the mass market players like Hero Motocorp and the Bajaj Auto, and now the valuation gap has been widened between the Hero Motocorp and the Bajaj Auto. We continue to like Hero Motocorp in the two-wheeler space, followed by the Bajaj Auto, given that Hero Motocorp is trading at 20 times, almost 30-35% kind of a discount to the Bajaj Auto, and the kind of a revival we've seen in its EBITDA margin, along with the improvement in its market share in the EV space and its product launch plan. We believe that although the market valuation gap will not be breached completely, but there is a room for Hero Motocorp to improve its valuation from the current level.
Okay, Abhishek, we got that. So, we've got your view as far as Hero and as well as Bajaj is concerned. We also want your view as far as Aisha Motors is concerned. Aisha Motors actually in the month gone by saw a dip in sales both on a year-on-year as well as a month-on-month basis, and also appears to have lost a little bit of market share in the premium segment. So where do you stand as far as Aisha Motors is concerned? And in Aisha's loss as far as market share is concerned, which are the stocks or which are the companies do you feel can actually go ahead and gain further market share?
See what is happening that for last 4 to 6 quarters, if you see that the Eicher's quarterly volume for Royal Enfield, the quarterly volume has been stagnant between 225,000 to 30,000, and considering the kind of performance it has shown for last 1 to 2 months, I think that same would repeat in this quarter also. But what is changing in the Eicher Motor is that because of this Sherpa platform, the volume mix from the above 350cc segment has been rising, and now it is standing at 16-17% compared to the 10-11% earlier. So that will give some sort of a benefit to its ASPs. But you rightly said that as the mass market players are doing well, this particular player is not able to catch up the volume growth. Also, that will impact its market share, and it's in line with our investment thesis for the two-wheeler segment. We have been liking more of a mass market players like Eicher Motors and Bajaj Auto compared to the premium iconic premium player, where the demand is still skewed towards the premiumization, but the premiumization has been happening in between the categories. It is not the same as was happening before COVID. So in that way, we are more preferring this Bajaj Auto and Hero MotoCorp compared to the Eicher Motors in two-wheeler space.
And what about M&M? That's been the second best performing stock, not just in the auto pack, but even for the market as a whole in the large cap space. So M&M is also up 61% on a year-to-date basis. Where do you stand on M&M? What are the triggers going forward?
See, for M&M, what is happening that it has been getting new capacities in the PV space, and considering that the PV segment is expected to grow by up to mid-single digit kind of a growth, but because of the new capacities, new product launches, and along with a healthy order book, we assume that the Mahindra & Mahindra may outperform the PV segment growth in FY25, and as earlier it was expected doom kind of a bleak outlook for a tractor segment, but post Q1 the kind of a monsoon has been trending, and the kind of rural demand is picking up. The outlook for a tractor segment has been improving, and these both things are supporting the M&M. And beyond that, what is structurally happening in the company is that earlier its whole operating performance was dependent on the tractor segment only, but with this new success of the new product launches in the PV segment, gradually the contribution of auto sector in its operating profitability has been increasing, and this is auguring well for the M&M. Beyond that, its plan for this EV program has been on track, and that street has been liking so far.
Abhishek, what about Maruti? Management commentary has been quite muted in terms of PV demand. You've also seen the company go ahead and give quite a few substantial discounts yesterday. In that light, as well as the upcoming festival season, how do you see demand panning out for Maruti?
Firstly, Maruti is a representative of PV segment, given that it's a market leader, and you rightly said that the inventory levels are rising in the PV segment. And if you talk about the festive season, then there is a largely high base would play out in this year, because last year was very good because led by the demand supply mismatch. I think last year in a 42 days for festive season, the PV industry sold almost 5,45,50,000 kind of per unit. So high base is there, and on top of that, the entry level segment is still to pick out, and that has been reflecting in its valuation and the performance. I think Maruti, if you take about the 1 year kind of a period, then Maruti is being largely underperforming to the Nifty auto index, and the larger part of its performance is driven by the earnings only. There is no major re-rating has been seen in the Maruti, which was seen in the other companies. So now what is happening that the inventory at this point of time, inventory is rising. before COVID, we used to see that the pre-festive season, there is a period when OEMs build up inventory, and that has been utilized during the festive season. But what has been different in this festive season compared to the pre-COVID festive season is that, one, the size of the overall market has been increasing. So 30 days or 40 days kind of inventory previously, and now 30 days, 40 days kind of inventory have a different kind of financial pressure on the dealers. And two, the competition has been rising. So continuously, this players like Tata Motors and Mahindra are gaining market share with their new product launches. So these two things are putting pressure on the Maruti, and that has been reflecting in its valuation. What has been in hope currently is that the kind of inventory which has been built up so far may get clear during the festive season. And even if that would happen, the outlook for the overall PV segment would not change significantly given the high base and the low retail uptick. So we believe that the valuations may stagnate for Maruti for a time being. Till then, breakout in its volumes would come out.
And if there is an increase in GST rate for the car seats, as we are picking up from our sources, then the cost of ownership for a four-wheeler also goes up. So that could hurt consumers over there, customers there. So potentially negative for a Maruti Suzuki. Abishek, thank you very much for joining in. We'll slip into a break and come back with more.
Welcome back to Trading Hour. Markets continue to see moderate moves while the broader end of the markets continue to outperform. The stock in focus is Alm Labs. It's higher in trade post its analyst day. Ekta is here with more details.
Well, yes, Alm is in focus because of its analyst day takeaways. It hosted sell-side analysts for a Q&A session, which was with the new management team. Now, Jefferies has written on Alkems. They have an underperformed with the target price of 5,080. A couple of takeaways, according to them, was low-hanging fruits like boosting operational margin will be the top priority for the company in the near term. Investments in new areas will take 2 to 3 years to bear results. Alkem aims to be more active in M&A and in licensing going forward. The new management plans to pursue profitable growth, which will be realized via India, EM and the CDMO business. JP Morgan has a neutral and a target price of 5,870. A couple of key takeaways: increased focus on driving profitable growth. Margin improvement is likely to be visible from FY27. Domestic and emerging market business continue to be priorities. They are keen to pursue inorganic opportunities in the chronic segment in India, and they sounded optimistic on their recent in-licensed med tech business.
Thank you so much for that, Ekta. Markets clearly liking the kind of commentary, stock higher by over 1% today. But that's all the time we have on this edition of Trading Hour. Stay tuned. Halftime report is up next.